Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Chicago wheat and corn.
Chicago wheat. During the summer, the market fell below the significant neckline extension, currently at 656, of the small October 2020 to November 2020 head and shoulders top, which you can see highlighted on my daily chart in dark blue. This neckline had, and still has, a fairly wide congestion area clustered around it, formed from late April to mid-July, from about 609 up to 679, including the declining long moving average, currently at 648, the declining medium moving average, currently 623, and below it now the short medium moving average, currently at 598, which is highlighted, the latter is highlighted in green on my daily chart. It is this congestion area that had been pressuring the top of rallies throughout September, October, and now into November. 6 weeks ago I also said, and I quote, "We have also seen a pattern form over the last few weeks. The pattern I have in mind is an unusual one, is one that immediately springs to my mind but looks in the wrong place. And that's to see the whole of the late May to end of July action as a double top, with a neckline at the same neckline extension of the small but influential October to November 2020 head and shoulders top." End of quote. After much pondering, I realized this pattern was called, and I kid you not, a cat's ears pattern. In essence, it's a double top in an overall previously downward moving market. It is not that rare, but enough that it took me a while to remember its name. The potential below for a cat's ears pattern remains at target X2 in the 502 zone. However, before we even look down there, we have some interesting supports, some penetrated and some not so much. So the notable ones are, and on the closing basis, is the May 2023 low at 587 3/4, which is just below the March 2021 low at 592. Now this support has been thoroughly penetrated, but prices are back up over the 587 3/4 level, if only just, so it is worth considering. Additionally, and this is only on a pure low for the day basis, the September low at 570 even, which was tested in early September and again at the turn of the month from September into October. And then once more last week, and then penetrated this week, but only with the one single close below before a strong move back up. A move back up which I will deal with shortly. In the meantime, the potential target X2 is interestingly also just above some quite historical congestion supports between 495 to 500. Now onto this week's action, and just above the market you can see the descending short medium moving average in green. This moving average has acted as a dynamic capping action of sorts since about mid-October. I say sorts as it has been penetrated, but the attritional action of doing so has eventually worn away the rises, such that this week we have had the lowest low since September 2020. Not only this, but the reactionary move back up has set the scene for this week to be a possible weekly key reversal. Thus, if we have a close tonight, either over 577 or under 576, it's quite a narrow range, but 577 or 576, then we're beyond. Anything in between, and we have the lesser outside week pattern. At this moment, we are looking at a weekly key reversal up. Now, this begs the question, is this a change in the market's current mildly bearish stance? Well, the answer is I don't know, not yet at least. I do know that prices trying to get down to that zone have had a pretty heavy looking support below, ahead of the 38.2% absolute Fibonacci line at 521. But at the same time, we have topside, beyond the short medium moving average, we have the medium moving average currently at 623, arching lower, and then the long moving average currently at 648, not that much higher beyond that. Chicago corn. The medium moving average, currently at 497, highlighted in purple on my daily chart, has been an effective cap on this market since about March, especially recently in October, November, and earlier in June. When it was penetrated, it still managed to hold down the market. The capping action in October resulted in a push down below the mid-September to late October lower bull channel line, which is highlighted in green on my daily chart. This move put an end to a late July potentially rounded bottom pattern and also changed the aspect and broke the follow-on higher to a larger pattern here, a May to September descending wedge pattern. For the moment, I will hold off labeling targets below for the descending wedge pattern, as one, we are moving quite a distance from this pattern and thus its impact is diminished, and two, we may soon have another pattern presenting itself, one hopes. So in addition to the declining medium moving average, we also have the same old congestion band between 490 to 498 that includes the 2021 low at 498, as well as the flatlining short medium moving average, currently 494, pressing down on the market. The question now is whether the support below will hold. You see, we have seen how little is in the way until the lows formed over the summer around 473. So the question now is, will 473 hold? The first attempt lower this week has held, but is not an emphatic move back up, and I suspect we may soon see 473 being tested again. If on a further attempt lower prices do not hold, then we have some congestion starting at 463, but it isn't that strong, and I'm concerned the accumulated ammunition overhead from the descending wedge pattern and the bull channel may punch down through it fairly easily. For another week, it will now depend on the 473 zone below.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.